No questions, guys. I can tell you one thing. I know this is a lot of material, but and some of it's going to take some time to absorb. Having said that, I usually plan for some questions when I'm mapping these things out. So if none of you have any questions, which would be shocking, um, then this is going to end up going a little bit faster. But obviously, um, it's going to be something that we can cover in the private sessions and stuff like that. But at any rate, it is what it is. Yes, it is a lot to absorb. That's for sure. Um, I do see a couple people typing, so let's just hang on a second. It's just that no, I get it. I get it. I know. And that's why we do the mentoring. I know this is not something where we just do a 2-day session and say, okay, good luck, have fun. That's exactly why on this stuff that we do it like that, because it is a lot of stuff to deal with and try to figure out. It takes a little bit of time, but so that's fine. And when we get to the end, we'll open it up again for general questions as we continue to go through some of these strategies. But um, now I hope you guys understand why I break it down the way that I do. Like last week is clearly about one set of things, which is getting you to understand what options are, focusing on how to use it, alongside your day trading if you want to, or even for some basic swing trading. And then this is, options on steroids. So this is the whole other angle. But if last week you started to get a flavor in your mind of how important the options market is, but also how much money out there controls stocks through options. Now you've got to realize it's even bigger than what you thought, right? Um, and that's the complex part is people that break down and analyze. There's computer programs that will break down and analyze, how much volume has been in which options, and you can also see, for example, if you have the right data. Um, the floor knows exactly what everybody's doing, right? The floor knows if somebody puts on a bull call spread because you do it in one motion. You do it. You don't go buy the call and then sell the call yourself. You set the trade up so that you're looking for a certain spread or whatever between pricing, right? You want to make sure you get that pricing. So when you buy to open one, let's say, and sell to open another, somebody could watch that and say, oh, there goes 10 and there goes 10. That was probably somebody putting on a bull call spread. But when people do that all day long, you can't track it all. The floor knows what's going on, but there are computer programs and computer models out there that track all this data and come to conclusions about, what the net positions are out there. And then as a whole, because those positions add up to the control of a lot of shares of stock, that has an impact on the stock. I mean, think about it this way, right? And we kind of touched on this last week, but just think about it this way. If everybody owned puts on the SPY, the spiders, if everybody owned puts, let's say the spiders, whatever price, doesn't matter, right? 280. If everybody owns 260, puts a 260 strike price on the SPY, the S&P can't really go down, right? Because if everybody did it, I mean, obviously not everybody would own, but if everybody had it, then nobody can lose money under 260 because they can either make money on the puts or put the stock to whoever they bought them from. Now, somebody obviously sold them, right? But if that's the floor, that's one thing. If it's other people, that's another thing. So when the big players all own protection on the markets, let's say, then the reality is that the markets can't go down. But when they don't own protection, and that's why stuff like the VIX matters so much, right? Because that's really a measurement of how much volume is going off in these options on the major indices. And it's the same thing with all these complex strategies, right? If there's a lot of certain things going on, the stock can't move a certain way. Just like if there's too many people short a stock and it starts to go up enough that their accountants start to get margin called, what are they forced to do? Right? They're forced to buy the stock and then it squeezes. So, there's a lot of stuff that goes off options, lots and lots and lots. It's really important to get a head around why. And some of these are really cool things to trade with. These next two are really some of the first things I ever did in options. And, It's just different ways to look at the market. Don't run out and apply too much money to these things while you try to learn them. Or get a demo account or do whatever you have to do, or just map out the plays in your head. But it's very important to think these things through and understand them, because there's just so much that can be done. Okay, a straddle. So we're going to talk about straddles. What is a straddle? A straddle is buying both the call and put at the same time, typically close to the money with the same expiration. So this one, not so complicated in terms of buy this and sell that. Not diagonal where we have to go 1 month for this and 1 month for that. Not even vertical, because we're not picking a different strike price. The only thing, this is a horizontal trade in the sense that one's a call and one's a put, but it is a straightforward, you're buying both. So again, the strategy is buy a call and a put simultaneously with the same strike and expiration. That's it. What does that really get you? Well, you look for the stock to move enough in one direction to exceed the cost of the combined purchase. Everything after that's money made. Outcomes. If the stock closes at expiration within as many points either way as the cost of the trade, you can lose up to the cost of the trade. So for example, if it closes exactly at that strike price, you pick the same strike price. Remember, it's a put and a call at the same strike price. If you close right at that strike price, both the put and the call, ironically, are worth zero, right? So that's where you lose all your money. Whatever you put in the trade, you lost. If it's at all in either direction, either the put or the call has to have some value at expiration, so you lose less. If the stock closes at expiration beyond the cost of the trade, that's where you make your money. And again, the downside is limited to your cost. And here in this particular trade, the upside is essentially unlimited when we say unlimited. If the put works, the stock can only go to zero. If the call works, obviously the stock's not going to go to infinity. Okay, but unlimited meaning pretty much sky's the limit. Example, PayPal's at $115. And it doesn't matter when it is. It could be today, it could be next July when this is happening, or July when this is happening. The September 220 options, and I can promise you on PayPal this has got to be in August or September for the pricing to work like this. The September 220 options with the strike price of 115, so right at the money. Stock's at 115, we're looking at the 115 strike price. Cost $4 each. You buy 5 calls and 5 puts at the strike price 115. Okay. Total cost of the trade is $4,000. Why is it $4,000? Because 5 of them on the calls cost you $4. That's $2,000. 5 of them of the puts at 4 cost you $2,000. So the total trade costs you $4,000. Remember, I'm trying to mix up the examples, different sizes, so you think through the sizes too. It could be 1 of both, it could be 10 of both. At expiration, the stock moves to $138. So from 115 to 138 between the time you did it and the expiration in September. So let's think about it. What are those puts worth? Nothing. Okay. Nobody wants to sell the stock at $115 when the stock's at $138. So the puts are worthless. But the calls are worth at least at expiration, they are worth $23 each. And since you had 5 of them, that's $11,500. Right? So you made $7,500. You put in $4,000, you made $11,500. Took in $11,500 at the end. So you made $7,500. Note that you can close out one side of the trade earlier, leaving the other side still in play in case the stock swings back the other way. So maybe it starts to move up and it moves up 15 points, and there's still a few weeks left till expiration. You think, yeah, I think this, maybe you get at that point, maybe you get a seeker 13 sell signal on the daily chart, right? And go, okay, good enough. I'm going to lock in. I've already made money on the trade by selling the call. I've covered the cost of both. But I still have 3 weeks left and I still have the puts. So now that's free. Doesn't mean it's going to actually, the stock's going to swing all the way back to the point where the puts are in the money. But if it does, now you're making money there too, right? Or by the way, think of it this way. Okay. PayPal's at 115. You buy these calls for the example I just gave, 4 points each. PayPal moves up a little bit. couple, maybe 6, 7 points probably, something like that, to the point where the calls are worth 8. Okay, so PayPal, which can move a lot, only moves up 6, 7 points, but the calls move up 4. My cost was 4 each way, right? So at that point or any higher on the stock, if I sell the calls, the trade is paid for, but the puts are still there. The other leg still exists, and the stock's only up. You know, it could have moved, stock can move 6, 7 points in a couple of days, in one day, right? So now if it swings back the other way, right now I'm making money on the puts too. So it gives you some flexibility to make decisions. But the bottom line is, with the strangle, what you're looking for is what? This, right? We basically are buying. Here's the actual price of the stock right now. Okay, so we're basically buying the strike price right at the money. So I lose some money, until the stock either gets up here, moves up enough that it covers the cost of the trade, and then all of this is just more money made all the way up. There's no limit. Or stock moves down here, still losing, I'm losing. Now I'm losing less. Remember, that's the thing. Right here is where I lose the most if the stock stays here. But every price that it moves down, I'm losing less because those puts are at least having some value. Once it exceeds the cost of the trade by moving down, again, that exceeding to the downside thing, now everything I do here is just more money made all the way to, and no limit until the stock gets to 0. So, you know, what do you use something like this for? Earnings. I mean, think about it. We've seen some stocks this week with a little bit of gappage, right, on earnings. Tesla, Apple, Amazon. You don't know. Maybe they're going to miss. Maybe they're going to beat. But when they do, they gap. Oh boy, do they gap. You don't know if they're going to beat or miss, but you know that, yeah, it's potentially good, possible that, you know, and what a lot of people do, by the way, the money, here's a play. If I sat down and I take the big tech stocks, Facebook, Apple, and every single one of them, I go out and I put a strangle on right before earnings come out. And by the way, this last week, 2 weeks back, sorry, was options expiration, right? So if you're like close to expiration, you do the ones for that. I mean, you're only looking for this thing to gap on earnings, right? That's it. So you do it for something that's about to expire. There's no real time value. If the stock gaps big in the morning, you're going to make money either way, up or down. And if it doesn't, the next morning you can turn around and sell the options, and you'll probably lose a little bit because the options go up in value because people do this. More people will do it right before earnings. Options will increase in value ahead of earnings as people expect the possibility of a gap. And the people are buying the options to reflect that. So yeah, you'll lose a little money, but the next morning, if it doesn't really gap that much, you can probably close out the trade. One side might be worth a little more than it was the next prior day. The other side is going to be worth a little less, and you'll probably net lose a little money, but not much. You don't have to keep holding the stock. The whole point was to play earnings. I mean, you don't have to keep holding the option, right? So either it gaps or it doesn't, then you're out. There are people, this is what they do. And this week on Tesla and Amazon and Apple alone, a little bit on Facebook, could have done well. Facebook gapped down, the other 3 gapped up, right? Tesla big. I mean, for the price level of Tesla, that was a big gap. That would have made you a fortune on a strangle position like this. On a straddle position. Now we're going to talk about strangles. Oh, straddles, strangles. Tomato, tomato. A strangle is buying both a put and a call at different strike prices with the same expiration. So, whereas a straddle was the same strike price, this is different, slightly out of the money in both cases. Buy a call and a put simultaneously with the same expiration. Look for the stock to move enough in one direction to exceed the cost of the combined purchase. It's the same as a straddle, but costs less because you are buying options further away from the strike price. There is a difference, though, right? Which is that it's a little easier to lose money, too, but it costs less. If the stock closes at expiration within as many points either way as the cost of the trade, you lose up to the cost of the trade. All of it, if it closes basically right between the 2 strikes, we'll say in this case. If the stock closes at expiration beyond the cost of the trade, you make money. The downside is limited to your cost. The upside is mostly unlimited. Again, that whole thing about stocks either not being able to go below zero or above infinity or to infinity. All right, an example. PayPal is at 115. Instead of doing the 115 September calls and puts, I'm going to look at the 120 calls, so 5 points above the price of the stock, and I'm going to look at the 110 puts, so 5 points below the price of the stock. And remember how much those other ones cost, let's say 4 points. These are only going to cost me $1.50 because they're out of the money. Okay? So I buy 5 calls, that's $750. I buy 5 puts, that's $750. Total cost of trade now is only $1,500 instead of, what was the other one, $4,000? Now I use this example because it's kind of funny, but it doesn't have to be exactly like this. At expiration, the stock moves to 138 again, okay, or on the gap on earnings or whatever. But let's just say at expiration, the stock's at 138, just like the last example. Puts are worthless, and the calls are worth, right, $18 each. They're not worth 23 because it's not the 115s, it's the 120, so they're worth 18, right? Currently at 138, the 120 calls are worth 18. And 5 of those is therefore $9,000. So I paid $1,500. They're worth $9,000. I made $7,500. What was the math on the other one? I made $7,500 on that one too. I had to put up $4,000 to make that $7,500. This just happens to land exactly at that price the way you do this. It doesn't have to be that way. Sometimes, if the stock had been higher, I would have made the same amount more, but if it was lower, I might not have made the same amount, right? So it's not that you should always just do this instead of the other. In this example, though, it works out the same. I made $7,500. One way was off of $1,500. That's this way. The other way was off of $4,000 worth of me putting up money. Note that you can close out one side of the trade earlier, leaving the other side still in play in case the stock swings back the other way. When you do a strangle instead of a straddle, you put up less money, but there is a bigger range where you can lose money, right? Here's your risk graph. So this is the stock price. So this is the calls I bought. This is the puts I bought, right? I'm losing all my money at expiration if we don't get to at least one of those, right? That's the difference. In the other one, unless we closed exactly at the strike price, I'm not losing everything, but I'm putting up $4,000, right? So if it's a couple points in the money, I'm getting half of that back, let's say. Whereas here, if you don't at least get to the call side, the calls are going to be worthless. If you don't at least get to the put side, the puts are going to be worthless. You're going to lose the entirety of the trade, not just at the strike, because there's not one strike. See how that changes the risk graph, right? And then as we start to move beyond that, I still have to overcome the cost of the trade. So now this call is starting to go up in value, but I'm still not making money until I cover the cost of the total trade. Then everything's green and keeps going up more and more and more. Or to the downside, I have to get to that strike price. Now the put starts to have actual value at expiration, right? So I'm still losing money until I get to the cost of the trade. And now every dollar, every point, every whatever that the stock goes down is more money made because that put's going to be worth more. So back a slide or two again. There's the risk graph. Here's the one for the straddle. See how there's a 1 point you don't want it to be at? Because anything either direction is at least a value. There's a value to it. You're just losing a little less than, you're losing less than you put into the trade until you exceed. But when you get to the strangle, less money put up, but there's a zone where you can lose it all. See the difference? But if it gaps big, or if it moves big before expiration, you make money. And like I said, don't forget, you get into a trade, it starts to move up, gets to here, you get a secret 13 sell signal on the daily, you sell the calls, you've made money, you've already locked in. You can't not make money. Okay, if you bought this whole thing for $1,500, maybe up here you sold it for $3,000. So you've locked in, you've made $1,500, and you still have the puts until expiration. So if the stock were to go all the way back down, now anything it does below the put strike price is you making that, even if it goes to the point where the put's worth 50 cents, you still get, right, that out of it. So they can kind of play it both ways, right? You want, as long as you think there's going to be a movement. And remember, options are priced. The trick to something like this is, options are priced with a time factor. You're buying out of the money calls in this case. So, they're going to be priced at a level where, yeah, it's got to make a move to exceed that. That's why we don't typically buy out of the money calls, right? If we want to make money on a stock because we think it's going one direction, we wouldn't do an out of the money call. We would do a synthetic long, or we would buy an in the money call, depending on how we wanted to approach the market. But this is a play for what? This is a play for volatility either way, we don't know, which is kind of what earnings tend to create, right? But other things, biotech company waiting for approval on a drug, and it's supposed to come by a certain date. If they get it, boom, stock pops up. If they don't get it, boom, stock drops. Straddles and strangles, meant for those. Now, where straddles and strangles are all about, you want to move, let's now talk about collars. A collar is buying a put below the current price of a stock that is already owned, and then selling a call above the current price. So I own the stock, I buy a put with a strike price below the current price, and sell a call at a higher strike price. What am I doing when I do that? You pay for the put, which is protection, right? Now, if the stock goes below the price of the put, I can't lose money. But you also collect the cost of the calls. That's a credit. And what do you really want then? You want the stock to stay above the put strike minus the credit. If the stock closes below the lower strike price put that you bought, you will get to sell the stock at the price of that strike price of the put and keep the net of anything that you sold above. Remember, you've owned the stock first, already owned it, not just buying it right now. So it's something you've owned, maybe it's up, right? If the stock closes above the lower strike price put, or the lower strike, right, the put, you keep the stock and the credit from the sale of the call, but the put expires worthless. Okay, so you still have the stock, you made the money from the call you sold, the protection that you bought expires worthless. If the stock closes above the strike price of the call, your puts expire worthless, so you lose that. But you sell the stock at the strike price and you get to keep the credit, what you sold the calls for. It's a collar. I'm going to show you the risk graph of this one first, right? Because what you're basically doing is, again, here's the current price of the stock, black line. I'm buying a put. So anything under here, right? I can lose money because the stock's going down, but I can't lose more than what I can sell the stock at from the put plus the credit that I took in. But if the stock goes up, if it gets above where I wrote the call, I can't make any more money. But somewhere between a little bit lower, because I'm taking in some money and I'm buying a put, right? Depending on which ones I buy exactly, but general math, if you buy a put below and sell a call above, somewhere below the current price level of the stock, I'm still making money, and I'm protected. And I keep making money until we get up to the price of the call. After that, I shouldn't have done it because I can't make any more money, but the stock's still moving up. But again, if you own the stock first, if this is a tax play, the difference between this and the thing we talked about earlier is instead of just selling the covered call to lock in some extra cash in case the stock doesn't go much higher, here you're actually also buying the protection on the downside, right? You're buying the protection on the downside. So in other words, if I own the stock at 30 and now it's at 40, and I don't think it's going to do much else for a while, but I don't want to sell the stock yet for whatever reason, tax purposes, blah, blah, blah. I write the call above, I get to take in that extra income. But I'm also buying the put so that, and maybe I'm buying a deep out of the money put, right? I bought the stock at 30, it's at 40. Maybe I'm buying the 32.50 puts. They're going to be cheap. It's just there for a worst case scenario. Stock drops 10 points. At least I only gave back 7.5 of them. I got to sell it at 32.50. I bought it back at 30 originally, right? But those puts are going to be super cheap because the stock's at 40 and those 32.50 puts are way out of the money. Meanwhile, maybe I sell the 40 calls or the 42.50 calls and I take in a lot of money. So now I'm pretty much protected. I mean, I own the stock at 30, right? I can't lose anything under 32.50 because I have that put. That was cheap, but I'm writing the calls to take in the income at the 40 strike or the 42.50 strike. As long as the stock stays under that, I still get to own the stock. If it goes above that, I'm going to make money. I'm going to make, like I sell the stock at the strike price of that call, plus I get to take in the credit of the call. But I had to pay for that put. So it lets you not have a lot of risk, take in some extra money if you don't really think the stock's going to do much for a bit. And even if it does, you still make money. It's just that you're capping. This is one of those where you're capping what you can make. Bull put spreads. You did bull call spreads. Bull call spreads, by the way, what did that mean? We were bullish. We wanted the stock to go up, or we thought the stock was going to go up. And we used calls to do it. How are we bullish and we're going to use puts? Well, it can be done. A bull put is a credit trade that involves buying a lower strike put and selling a higher strike put. So you're going to simultaneously sell a put and then buy a put below that. You're going to buy the lower one, sell the higher one with a net credit spread. So in other words, if the stock's at 50, if the stock's at 47, right, I'm going to buy the 40 put and sell the 45 put. Which one's going to be worth more? The 45 put is worth more because it's going to be in the money faster, right? As the stock moves down, it's a put. So I'm, by definition, the one I'm selling is worth more than the one I'm buying. I'm bringing in a credit. If the stock goes up, I just get to keep that credit. End of story. That's what the goal is. That's what you want. So if the stock closes between the lower strike price put that you bought and the higher price one that you sold, you lose the difference between the two strikes minus the credit that you took in. Right? So again, if there was a 5-point difference in what I just discussed, 40 to 45, I'm going to lose that 5 points, and but I took in a credit. So minus whatever I took in. Excuse me. If the stock closes between the two strike prices, you will have to buy the stock at the higher strike price. But you get to keep the credit. Right? So in other words, the other two, because I closed below both prices in the first scenario, the whole trade's a wash, right? I'm going to put the stock at one price, and then I'm going to sell the stock at the other price. And then I'm going to keep that credit and lose the 5 points in that transaction, keep the credit. Here, we close between the two strike prices. I'm going to have to buy the stock at the higher strike price, but I get to keep the credit, and the other one expires worthless. And if I stock closes above both strike prices, I get to keep the entire credit. So what do you really want in this transaction? This is what we call a non-picky bull trade. All I really want is for the stock to keep going up. And I'm trying to bring in some money, and I'm trying to know exactly how much I'm risking. Right? So in this scenario, what's key is here's the black line. That's where the stock currently is. And then here's the strike prices, right, of the puts I'm buying and selling. Selling the higher one, buying the lower one. Right? Actually, selling the higher one, buying the lower one. It's here and here. once you get below the lowest put, I can't lose any more money. I can lose the spread between the two if it lands below, but I can't lose any more money, and I get to keep the credit. So, but what's key about this type of a trade? This is the risk graph on it. What's the key here? Stock sitting here, all it has to do is hold up. It can even go down a bit, and I'm still making the money on the trade. So all it has to do is hold up, right? The red is all it has to actually make a move down before I start to lose money, and then I can only lose so much money. Bear call spreads. It's going to be the flip, right? Now we're bearish. We want the stock to go down, but we're going to use calls. A bear call is a credit trade that involves buying a higher strike call and selling a lower strike call. So you're going to simultaneously sell a call and then buy a higher strike price call with a net credit spread, right? The one you sell because it's lower is going to be worth more than the one that you buy, which is further out vertically. Collect the difference. If you want the stock to go lower, you get to keep the credit. It's just the same as the bull put spread, but in reverse, right? So in this case, if you wrote, the black line's actually right here, and it's because you're doing one of them right where the price of the stock is, and then one of them higher. Okay, you could do it lower. You can do it the other way, though, too. You could have done both of the strikes higher. You really wouldn't want to do it lower. There's not a lot of reason. You take in, you want to optimize how much you're taking in, obviously. But again, point is what? Stock heads down, you're green. You get to keep your credit. Stock heads up, you lose money in between. You can't lose more than once you clear the top strike call. You know, and think about it. People doing this stuff, you know, on Apple all the time. Because Apple never goes down until it does, right? You can sit here all day long and do these types of strategies where I can't tell you where it's going, and I don't want to own the stock that's expensive, but this month I want to bring in $3,000, right? I'm gonna go out and I'm gonna do 10 of any credit, and some of them can be really far out of the money on Apple, you know, or any of these bigger stocks. I mean, you can pull in 3-point credit using, let's say you thought the stock was going to go up, so we're back to the bull put spread, the one just before this. A lot of times you can find a 3-point credit on options that are 5 points apart, but 20 points out of the money, right? So now all I really care about is that the stock doesn't drop at least 20 points, and I get to keep my $3,000. People do this all the time. It works until it doesn't work, but I'm just letting you know that this is something that people do. And the logic behind it is this. And again, all you're doing is using options. Isn't this fascinating that we started out with these contracts that were the rights to buy and sell a stock at a certain price at a certain date and time, up to a certain date and time? That's all this started out with. And then people go, oh, well, cool. I think a stock's going to go up. I buy a call, right? And think about this. All these things where you can take in money and your risk is limited and blah, blah, blah. I mean, your risk is really limited in this, right? You can pick. You can pick on most of these. There's certain ones where your risk is unlimited, and you have to know that. But a lot of these, your risk is very confined, right? And so is your upside. You can be playing with Google and create trades using one option where your risk is very controlled and your upside is what it is. And you just want the stock to do X, Y, or Z, right? So when I tell you that the common use of options, because it's the easier thing for people to understand, is just to buy and sell puts and calls. And so how does the conversation usually start? Well, options, they're risky, right? I heard 85% of options lose money. True statement. You know what? Think about this though, by the way. Throw this into when we use that statistic. It's a true statistic. And we talked last week about the fact that, yes, because out of the money options mostly are priced to expire worthless, right? The floor loves you when you come in and buy an out of the money option because for everyone who wants to buy an out of the money call, there's someone who wants to buy an out of the money put, and they can't both be right. So the floor is going to sell both of them all day long. Most of the time, the stock doesn't get far enough to matter. And even if it does in one direction, people keep buying the next calls further out. So it can't keep going forever both directions. And most of the time, stocks just don't get to the strike price. Now, obviously, Apple's moving big, like a lot of these stocks are. They're getting to their strike prices. But buying out of the money options is a losing proposition. Doesn't mean that trading options doesn't make a lot of sense in certain scenarios. If you buy in the money options when you know a stock, or when you think a stock's going to go up because of the chart pattern, or you do it intraday because you buy the puts because you can't short the stock, but you know you're going to be out of it by the end of the day. Lots of reasons why they can work. But here's the other thing. In a lot of these scenarios, and think about this, when we say 85% of options, I always think they throw that number out there to discourage people from doing options. Oh, 85% of them. So that's the common wisdom on the street. 85% of them lose, so why would I do it? It's too risky. I don't understand it. And then when they do understand it, the only thing they get is, sure, oh, cool. Like I can put up no money and buy an out of the money call because I like this stock, right? And that's the thing that doesn't work. But here's the other thing. A lot of these complex strategies with two legs, and we're only on the two-leg one so far, for the most part. Think about it. In most of those cases, you can still make money, but one of those options is going to expire worthless, right? Because you're bringing in these credits, or you're paying, right? You're doing certain things where you want it to land in a certain place so that one of them has a value and one of them doesn't, right? Or even on a strangle or a straddle. By definition, well, unless you happen to, it goes up and then you sell the call and then it goes back down. Except in that rare event, by definition, one side of that has to expire worthless, right? So when they say 85% of trades lose money and don't, well, yeah, but like in all these cases, half of it is supposed to. 50% of the trade is supposed to expire worthless. So it's not, it's a skewed statistic the other way. It makes it sound worse than it is, when in fact options are a great way to do things in the market once you understand them. Butterflies. Okay, a short butterfly is selling a lower strike option. By the way, now we get in it. Forget the twos. Now we're doing threes and fours. Selling a lower strike option, buying twice as many middle options of the same type. So if it was calls, you're going to do calls again. And selling a higher strike option, again a call, with the intent of the stock move near or beyond the outer strikes. These can be puts or calls. Movement up. Oof. Actually, either way, right? So think about that. Because what are we doing? Go back to that. Look at that one more time. Selling the lower strike option. So let's do it with calls, right? If I sell a lower call, if the stock gets down to that price, I'm going to own that call. I'm going to own that stock at that price. But I'm going to buy twice as many in the middle, and I'm going to sell a higher. Or you can do this with all puts. What ends up happening, if the stock exceeds the higher the low, you make your money. Now, you can play with a lot of different risk graphs on this one. Every area can be wider or narrower in terms of where the money is made or lost. Here, there's a very small range where it starts to make money and then suddenly it's made everything. Whereas there's a big area in the middle where you can lose everything. But you can widen out the strike prices and you can change that. But the general look and feel of it is this. Hold on. I think I actually just flipped the risk. I flipped the risk graph, didn't I? This is, yeah. Sorry. That's a weird one to flip. So I did. I flipped that around. Sorry, guys. Short butterfly is buying a lower strike option. This is not the long. The other one was long. This is the long butterfly. Buying a lower strike option, selling twice as many middle options, and buying a higher strike option with the intent of the stock. So why do you do this? Remember, by buying the lower call, right? And again, then you want to right near where you're currently at, where the stock's currently at, near the strike price. And then you want to buy another one higher. So what happens there? By buying the lower call, I'm in the money. I control that stock. By selling the first one, now they're both going to be the same strike. That middle price is the same strike. By selling one of them, I've basically created a bull call spread, right? So I'm creating a range where if the stock goes lower, I lose money. Because if it gets under my lower strike, I own the call, which means I own the stock, and I'm going to lose that money. But I brought in a credit from the one I sold. So if it goes down, there's a certain point where I'm making money, and there's a point where I start to actually lose money. That's the bull call spread. What is a butterfly? It's really a bull call spread and the reverse of that, right? Because then I sell another one, and I buy another call higher. So what does that really do? Right? That's like getting short at the middle strike price with a call to protect me if it goes up too high. Think about that. Stock's at 50. I buy the 45 call and I sell the 50 call. Okay? So it's going to cost me at least 5 to buy the 45 call. To sell the 50 call, I'm going to bring in a credit. I'm going to sell another 50 call. Well, now I'm out of balance, right? Because if I just did one, I've got 100 shares I'm controlling. So I buy the call that I buy that's in the money, 5 points in the money, and the call I wrote can offset each other if the stock goes up. If the stock goes down, I can still lose when you get underneath the lower strike, right? I'll keep a credit from selling the one, but I can still lose money as the stock goes lower. But as the stock goes up, I can make some money, and I can make it's capped. Then I sell another one in the middle one at that strike price. Well, now the problem is, in theory, right? I sell the call, which means if the stock goes up, somebody's going to what? They're going to call the stock away from me. So now it's like I'm at risk of being short. That's why you buy the other call higher to protect you in case the stock goes up. Right? You're putting on a double strategy. So what happens here? I'm taking in 2 credits. I have the protection of owning half of the position, right? If it goes all the way up, I own half the position lower, and I'm buying a call out of the money to cover the other half in case it does that, to limit my downside on the upward move, because I'm double short in the middle. All I'm trying to do is what? I want it to stay in the range. I want it to stay somewhere in the middle here where I own the call, and I have the call that I bought lower, and that's safe. I collect 2 credits, and it doesn't get up to the point where, right, the other thing, those get out into play. If it's above that middle strike, both of those are going to get called away, but I can't lose more than where that top strike price call is that I bought. So I'm protected. The net of all these things, I'm protected. The only place I'm really not protected is on the downside, right? If the stock goes down too much, I'm just going to own the one call. I'll have sold 2 in the middle. Think about the math on some of these, right? If I bought the 45, it's going to cost at least 5. Let's say it costs 6. Let's say we're expiring soon. So that costs 6. What can I sell the 50s for? Let's say it's 2.5 each. What does a 55 cost me? Probably 50 cents, right? So I'm paying 6 at the bottom. I'm paying 50 cents at the top. That's $6.50 to buy the 2 sets of calls, one really low and one really high. And meanwhile, I'm bringing in 5 points. And if it was, by the way, if they were worth 3.5, I'm actually bringing in 7. So it could be a credit or a debit. I might be bringing in more than I'm putting out, or I might not be. But at the end of the day, right, where do I want that stock to land to make money? I certainly don't want it to go too low. But really where you want it to land is between the lower price call and somewhere under the middle would be ideal. because I get to keep both those credits, but I'm still in the money on the lower price call. And the out of the money one that didn't cost me anything, that's the part that expires. You can do the same thing with puts. It makes the math a little different. You're just flipping what you're doing, right? So one type of butterfly is buy the lower, whether it's a call or a put, sell two in the middle, and buy a higher. One type of butterfly is sell lower, buy two in the middle, and sell higher. Those are the different ways to trade a butterfly. I will tell you that these last few, this and the next one, they are, the last things you should start playing with in options. But people do start to do them. I mean, at the end of the day, here you're using 4 options contracts. And depending on which way you go, you're either wanting the stock to stay condensed or you're wanting the stock to expand. By the way, that's part of why they call it a butterfly. If you do the risk graph, or I'm sorry, if you do the, not the risk graph, but there's a chart that'll show you the positions. It's a butterfly. It looks like it's opening, closing. The condor, the reason they call it a condor, I'll show you some of these. I can show you those later. They're not as important as the descriptions. There's a reason, though, that they call these things what they are, because on a certain type of chart, they look like condors and butterflies. So again, a long butterfly, let's again use the example of a long call butterfly. You're going to buy one in the money call, lower, sell two in the at the money, and you're going to buy one out of the money. So the maximum profit would be achieved if the price of the stock at expiration is the same as the 2 you wrote. That would be the ideal, right? Because you get to keep it. You're still in the money by the call you bought at the bottom, but you get to keep the entire credits that you wrote the 2 for without having to have the stock called away. Everything that goes above that, the stock starts to get called away, and it gets called away double than what you have. But if it goes too far, you've got another call to protect you from that big of a loss, from that loss. So there's a certain point where you can't lose more on the upside. There's an ideal point, which is if it closes right at the middle strike price. And then on the downside, of course, you've got double credit that you wrote in the middle, but where you're in the money against that, once you get below that price, then you're actually losing money. And you can keep losing money until the stock goes to zero. You flip that to puts, right? Then it's basically the other way around, right? You want it to still close at the middle. If you're buying the puts, I'm buying the upper put and the lower put. I'm selling the 2 in the middle. You still want it to close dead in the middle. That would be ideal, because the upper put will be in the money, but the 2 lower puts will get you that full credit, and you don't have to get put the stock. So anything that you go lower than that, now you're going to get put the stock, but you've already got it from a higher price on half. Again, it's the funny thing about these things is that a lot of it is very controlled, right? And unless really crazy bad things happen to the stock, you can bring in income on this, right? If you're pretty sure that Apple's not going to, I wouldn't do it now, but if you're pretty sure that Apple's, middle of the quarter, nothing else going on, the economy looks fine, and you're pretty sure that Apple's not going to go lower, but you don't want to get all wrapped up in exactly this and exactly that, oh, it's going to go exactly this day, move this. I'm day trading, right? All these, that's what I mean by exactly this and exactly that. Or even swing trading by a day or two and having to hope it doesn't, having to stop out and all that stuff if it doesn't work. Here, you're putting on a position that allows you to basically, as long as it doesn't do the one thing you don't think it's going to do, which is go significantly lower, you're going to make some money. Condors, long condors. Long condor is buying a lower strike price call, selling a call higher than that, selling another call higher than that, and then buying an even higher call. Okay, so what's the difference between a condor and a butterfly? They both have four legs, not in real life. They both have four legs on an option strategy. The difference is that the butterfly, the ones in the middle are both at the same strike price. Whereas here, right, they're not. And where you do that, where you put that in, affects whether it's a credit or a debit trade. Buy a call below the current stock price, sell a call above that, but below the current stock price, sell another call above the current stock price, and then buy a call higher than that. What if you did both of the middle ones higher than the current stock price? Well, then that's a trade that's less likely to get called away from you and cause you a problem because you're out of the money on both of the two you sold, but you're going to take in less of a credit. Meanwhile, what they're really banking on here is what? I own the stock lower from the call that I bought. I'm taking in income, and actually probably pretty good income because the one I'm selling is actually in the money as well. Then I'm taking in some more income, but less than the first one because I'm selling another call. And then in case that gets out of control and the stock moves up too much, I'm buying this cheapie way out of the money, right? Sometimes with these four-legged strategies, it's easier to break them down to 2 and 2. Not on paper, not when you place the order, but in your head, right? Because when you're placing the order, what people want is, oh, I'll do this trade as long as I can bring in enough of a credit to justify it. So you're putting all four legs in and waiting for the floor to say, I can sell you this and sell you this and buy this and buy this, and you're going to end up with this credit that you wanted, right? And if my credit's not big enough, maybe it's not worth doing the trade. So you put it in as four legs. That's what most of the platforms will take. If the stock closes between the two middle strikes, you make the difference between those strikes minus the cost of the trade. If the stock closes below the lowest strike plus the cost of the trade, or below the highest strike minus the cost of the trade, you lose the cost of the trade. Anything else results in a smaller gain. So your risk is capped. But what you want is for it to stay in the middle. There's your risk graph. What people will do is your options, if whatever platform you're using for this stuff, your options platform will usually have something like this that you can line up against the price of the stock. So if I see, for example, that the stock's been stuck in this range here, and I line this thing up and I put the strike prices, and you can widen the strike prices out or narrow this, right? How far out do you want to go? It's Apple. Let's say Apple's $350, right? If Apple's been sitting in a range, which it hasn't lately, but so let's just say XYZ. If XYZ has been sitting in a range between 330 and 370 for a year, then I'm going to line the strike prices up here and here, right? So you got support down here and resistance here, and we're dead in the middle of it, right? And I'm going to put on this trade. Because now, as long as we stay range bound in the range we've been stuck in, we have very established support and resistance, I'm going to make money. And it's not until you exceed that you start to lose the money. So it's a range bound play. You can do the same thing with puts instead of calls, and you're still banking on a range bound move to make money. These, I know, are the types that you have to go through and actually write out some examples in your head and watch them. Short condors, this is going to be the opposite. Selling a lower strike price call, buying a call higher than that, buying another call higher than that, and then selling an even higher call. Sell a call below the current strike price, right? Selling the call. What does that mean? That means I'm going to take in money from one that's deep in the money, right? If the stock's at 50 and I'm going to write the 40s, I'm 10 points in the money. I'm going to take in at least 10 points of credit. Then I'm going to buy a call above that. So if the stock's at 50, that was the 40. I'm going to buy the 45. Well, that's going to cost me at least 5. So I'm going to make a spread there. Then I'm going to buy another call above. So now we're at 50, we'll go to 55. That one's going to be pretty cheap to buy. And then I'm going to sell a call further up. That's going to be cheap to sell. You're creating a range that you want the stock to be out of. not into, out of, to be profitable. And you can do the same thing with puts. So I didn't put the risk chart up with that one. Yes, I did. There it is. By the way, if the stock closes between the two middle strike prices, you lose all or part of the trade, depending on where it lands compared to the credit that you took in. If the stock closes beyond either of the widest strike prices, you make money. The maximum gain is where, right? Between. After that, you can't make more. It's like, okay, so what am I doing here? What's the difference between a straddle and a strangle and, whatever? The difference here is that it really doesn't take, when you do a straddle and strangle, you're just pure buying something, right? Here you're actually creating credits and debits, and they don't use up much in your account at all. You just want it to get past the range that it's in. So, for example, stock breaks out of a range that it's been in for a long time and makes a decent initial move. Okay? Well, guess what? Sometimes those turn into short squeezes and keep running hard. Look at Apple. Look at Tesla the last year. Sometimes there was a reason they were in that range in the first place, and they're going to fall back into that range. So once it's broken out and made that initial move, and you feel like it's got, it's a stock that's traded and heavily traded, so there's interest, you can put on this trade, and now if it moves back down to get into the range, or if it keeps running, now you're going to make money. And again, not using a ton in your account to do it, even to do 10 of them, would not cost you anywhere near. And what are you going to do with the stock when you don't know? It's either going to go one way or the other, right? There's no stock position for that. It's called being flat, right? And we're almost done. Iron butterflies. An iron butterfly is a credit trade that includes buying a lower strike put, selling a middle strike put, then buying and selling a higher middle strike call, and then buying a higher strike call. So you got two puts on the downside. You're going to sell the two in the middle. You're going to sell a put a little bit under the stock, and you sell a call a little bit above the stock. But you're going to buy a put even lower, further out of the money, and you're going to buy a call further out of the money. Here, what do you really want? You want the thing to stay, right? You sold the two things that are most expensive and near the price of the stock. What you did was you bought coverage if it really moves too much. You bought coverage to limit your risk. So look at how narrow the worst case scenarios are here. Anything in the middle makes you money because you're collecting all those credits from the closer in put and the closer in call. That's all your money to keep. If you didn't buy the calls and the puts that were further out, you would have no protection. So if the stock made a move in one direction, you're going to end up what? Screwed. Right? Stocks at, just do it like this, right? Stocks at 50. If I just sold a 55 call and I didn't have any other position on it, just one leg, right? If I just sold a 55 call until I sell it for $1, I get to keep that $1 as long as what? As long as the stock stays under 55, right? But if it goes above 55, I have unlimited risk. If it goes to 300, I'm going to lose 245 points minus the $1 I took in. So that's crazy. If I sold just a put, we talked about shorting puts. That was one of the things earlier, just short a put. By the way, the reason you don't ever just sell a call is because it is actually unlimited risk. The stock can go to infinity in theory. Anybody that sold a naked call on Tesla when it was at 200 is just getting hosed right now. They've lost their house. They've lost everything. If you just sell in a put, so the stock's at 50, I sell the 45 put, I bring in the point. Stock goes under 45, I'm going to get put the stock. I can lose 45 points. It can still go to zero. Now, again, that's the extreme. So anything below 44, I take it. Now, think about that. Stock's at 50. That's your black line right here. I sell the call higher and I sell the put lower. I bring in $1 each. So what happens is I brought in 2 points. And I did that. Remember, the stock's at 50. I did the 55 and the 45. And I got in 2 points, which means I can, if it goes 2 points past 45 or 2 points past 55, higher than 55 or lower than 45, I'm still technically making money, right? because I'm going to start to lose money when I get put the stock at 45, but until it gets to 43, I brought in 2 points. So anything between 43 and that math, 43 and 57, I'm green. Then I start to lose money. But in this scenario, remember what I did? I bought cheaper calls and puts further out. So I can't lose beyond those points because they've got me protected. That's why you get max out. So anything in the middle is making you money. It's a pretty cool little trade. Last one. Iron Condor is a credit trade that includes buying a lower strike put, selling a middle strike put. This is the opposite, right? So a minute ago we were... Oh, did I just repeat that one? Oh, the difference was, I'm sorry, I read it. The iron butterfly, just like the other butterflies, these two in the middle, the selling the put and selling the call, are at the same strike price. I don't know how I messed that one up. The butterflies are always, the stuff in the middle is always the same, right? Then there's one leg out and one leg out. The condor is when you spread it out. That's why there's less. Here's on this, right? Everything in the middle is fine because they're both at the same strike price. When you do the condor, now now you're doing the call above. The description I just told you a minute ago. The call was above and the put was below. Those are the ones I sold. And then I bought the protection further up. That's this. The other one, the two middles were the same. So you're still taking in, you're actually taking in a bigger credit because they're both close to at the money. And then you're just buying protection in case it goes further out. Same concept. Just the middle stuff is either exactly at the same strike price or the call's a little higher and the put's a little lower. It's the only difference between the iron butterfly and the iron condor. Complex, but fun. All right. So in conclusion, options allow you to take on positions without using the same risk as owning the stock. Right? Period. I think we all understand that. In a variety of different ways, that's what they're designed to do. Options allow you to short stocks that can't be shorted, which is cool. Options lower your risk on swing trades. Right? If you're going to hold a stock overnight, why in the world would you put up all the money to do the stock? There is either an in-the-money options play or one of these more complex strategies that takes a lot of the risk off the table one way or another. Different way to look at the market. Options allow you to take on complex strategies to make money out of minor moves, major moves, or a lack of movement in stocks or in the markets. Right? Depending on the strategy, either we want it to kind of go higher but not much, or either we want it to go a lot higher, or either we want it to just go a long ways in one direction, or we don't want it to move at all. We want it to stay here in the middle. Think of those iron condors and iron butterflies like if I reverse to straddle, right? The straddle is where I buy a put and a call at the same strike price. I want them to go far either direction so it covers the cost of the trade and keeps going. Either way, I don't care. And then I start to make money, right? Well, if that's true, then what's the iron condor? I'm selling the put and the call to take in a credit. Well, now I don't want it to go too far, right? I want to stay in the middle, so I just get to keep the credit from selling that trade. But if it does start to move and it moves too far, essentially what? If it moves far enough that the straddle would have started to make money, then you're starting to lose money. Think about that, right? If you sell the two instead of buy the two, when you buy the two, you need it to get so far, and then you start to make money. When you sell the two, you're collecting a premium. You don't want it to go anywhere. If it moves enough that you would have made money buying the straddle, now you're losing. So why do you then buy the lower put and buy the higher call? To protect you from it getting too far out of control. That's your iron condor, right? But in the meantime, really, what do you want? You just want the stock to sit in the middle. How much of a spread can you collect? Go look at an options chain, or actually, well, let me, in closing, there's that, but let me hop back all the way to the one options chain. I know we had a lot more options chains last week. Last week was about the chain. This week was about the risk graphs, right? So I'm going to take this all the way back to the one options chain that we had. There it was on Lyft. just to give you an idea. And Lyft's not a big moving stock, but when it's at $47.50, the 47.50 calls are $1.32, and the puts are $1.30, and these don't expire for 3 weeks. So you got 3 weeks. Okay, so if we buy the call, $1.32, and we buy the put, $1.38, right? What are we paying? $270 by 10 by 5 of each, $2,700, right? $270 net paid. So what do I need? I need Lyft to basically go more than $270 either way. So I start to make money if Lyft gets above $50.20, and I start to make money if Lyft gets below $44.80. Everything after that is gravy for me. And if you go, yeah, I mean, but that's a pretty big spread, Chris. I mean, boy, that's a 5-point range in Lyft, and I just don't think that stock moves like that. If you look at the chart, it doesn't really move like that in the 3-week range very often. No problem. Then let's short it instead. Let's sell it at 127 and sell it at 131, and we just took in almost $2.70, right? Which means what? The stock has to exceed $50.20 or below, exceed to the downside, my favorite phrase, $44.80 before we start to lose money. Huh. Well, that doesn't seem, you just told me you didn't think that was likely. So we're making money if it just stays between those two prices. But yeah, let's be honest, it is a little bit of risk because, I mean, if this thing really moves, and it can move, we've seen it in the past on Lyft. I mean, if it really, really starts to move, then that trade is going to really start to hurt us at a certain point in time. Unless we bought some protection. This is that iron condor, right? So now we're saying under 44.80, we start to lose money. Well, I don't want to protect it right there, but let's say under 43, right? Instead of being subjected to, the stock going all the way to zero in theory, right? That's the risk. For 17 cents, I can buy this put. So I needed 5 of them, right? It's about $80 on the total trade. And in case it goes up, what did we say? 50-20, so 51. Or actually, no, it'd be 52 to do the same math. 12 cents, $60. So now what have I done? If the stock stays between 44.80 and 50.20, I made some money. We feel fairly confident Lyft can't make that move. But just in case it does, for very little extra money, I guarantee that I can't lose too much, because anything under 43, I've got the put, and anything over 52, I've got the call. 51, 52, 51, 50. It's so weird when there's all these 50-cent strikes. It's so different from what it used to be. So, you see what I'm saying? It's not a high-risk strategy that way. There's really only, Lyft has to really get past a pretty big move, and even then, you can only lose so much because you've got these cheap options protecting you another point change along. That's what the iron condor was. The reverse straddle with protection. Doesn't sound so bad when you say it like that. It sounds horrible when you say it's a 4-leg complex strategy. All right, guys. Does anybody have any other questions? I know this is this is going to be a thing to absorb. But if there are any questions you'd like to have me go over today while we're here, I would be happy to do so. If not, then we'll be wrapping this up. You'll be reviewing hopefully both parts of the course, and we will go from there. Yeah, right. It is definitely different. Somebody's still typing. Yeah, mentoring will definitely help a lot. There's no doubt about it. You take the information, start to line some things up with some charts. You know, doesn't really cost much if you don't already have it to get the options data. It's a few bucks usually. It's not a big deal. But and by the way, if you're not actively trading it, any platform should give you delayed data, 15-minute delayed data for free. Do you know what I mean? So it's not the end of the world to play with it that way. And the good question is, what can you not do with options? Yeah, right. Okay, okay guys. I will, schedule your mentoring sessions whenever you wish. Contact me as usual. For those of you who've gone through the program and schedule them up, I will get recordings of this up. Actually, let me stop those right now for a second.